Hi there, welcome to another live webinar with us from Phillip Nova. This is your MC for today. My name is Sri, and we're going to be discussing Singapore market insights, the opportunities and challenges ahead. In this session, it is with great pleasure that we have in the studio SGX Market Strategist Mr. Geoff Howie, with close to over 25 years of experience in the financial markets and economics, and he will be sharing with us a comprehensive overview of the current economic landscape in Singapore. He will also be highlighting key trends that you want to take note of, emerging opportunities, potential obstacles that businesses and investors may encounter. So stay tuned for this webinar where you can gain insights and unlock exciting opportunities in the Singapore markets. Key takeaways for the members of the audience. There will be a discussion from our guests in the studio on what are the key facets of the Singapore market is faring in 2024, and what are some of the key economic events that could provide inflection points for global economy moving forward, and how key themes such as digitalisation and sustainable solutions are impacting the Singapore market. About the speaker, let me tell you about him. Mr. Geoff Howie is Singapore Exchange's market strategist. He's very well known in the local space, is a very popular figure, appearing at all the major local events. He has more than 25 years of experience in financial markets and economics, strong background in global macroeconomics, and has a reputation for expeditiously identifying key market drivers and their impact across major asset classes. He is the creator and author of the SGX My Gateway report, which we all receive, which highlights local market highlights and developments, and it has been serving investors faithfully since 2012. This report is one of the most read and regarded of the Singapore financial markets, with one of the largest subscriber bases. Mr. Howie has led numerous content campaigns for SGX and is a leading market communicator to the investing public. He pens the weekly Insights column in the Business Times, in addition to speaking with CNA, 938 Live every Wednesday, and Money FM every Friday for market roundups. Mr. Howie was also named a LinkedIn Power Profile in 2018. All right, so I hope that is getting you excited for the content for today. Let me introduce his two other guests who will be in the studio with him. First, we have Simon Teo, Senior Strategist for Phillip Nova. And that's Simon appearing on the camera right now. Hi, Simon. Good to see you. And with him, we have Danish Lim, who's our investment analyst with Phillip Nova. You probably have read his comments and interviews with the media. And he also appears on Money FM as well. So you have two Money FM personalities with you in the studio today. Okay, so before I hand the time over to Simon, let me just do a quick poll to see if you can hear me loud and clear. We have some exciting polls for you today. But first and foremost, let me check if you can hear me clearly. I'm going to launch the poll right now. All right, members of the audience, give me your answer via the poll. Let me know if you can hear me loud and clear. At any point in time, if you have questions, you can go to your control panel and type your questions in the questions tab, which is located somewhere at the bottom. And we will be able to pick out your responses for the Q&A segment at the end of the session. All right, thank you for verifying that you can hear me loud and clear. We have 50% voting yes. That is lovely. All right, Simon, I'm going to hand the time over to you right now. If you're all set to go, it's over to you, Simon.
Okay, thank you, Sri, and good evening, everyone. Thank you for joining us today for this fireside chat. Hi, Geoff. Pleasure to have you today.
Yeah, good to see
I can
you.
hear you. Yep. Hi. Looking forward to hearing from you later. And hi, Danish.
Hello, good to be here.
Yep, welcome. Yep. Welcome to you. And first of all, before I begin, I'd just like to highlight some disclaimer. For tonight's session, it's purely for education purpose only. So any examples or illustrations does not constitute to any trading calls or financial advice. All right, so now I know we can't wait to hear from our experts. But before we hear from them, we would like to hear from you, the audience. So right now, what are we going to do? We're going to do a poll. Okay, so you should see a question popping up on your screen. So we just need to click to vote. So Sri, I need your help to show the questions on screen. So the first question that we will be asking you is, do you think the Singapore equity markets will end the year in positive? All right. So do you think the Singapore equity markets will end positive in 2024? Please vote. And we can have a feel of how everybody's feeling about the Singapore equities market. All right, another maybe 5 seconds. Okay, if you're done, Sri, can you just probably show us the result?
All right. Just to summarize the results, we have 58% who have voted, 55. Okay, now it's dropped to 50-50. Okay, right now it's 46% think yes, I think the market will end the year positively, and the rest are thinking no. Right now it's a 50-50.
I see. So actually, it's quite a mixed feeling, mixed mood in the market right now. So of course, let's now hear from the expert what they have got to say. We would like to begin with a recap of the Singapore markets. So Geoff, I know you
Yeah.
can't wait to start telling us about the Singapore market. So can you
No,
share with us,
yeah.
yes, what has been driving the Singapore stock markets since we emerged from COVID?
You know, one thing at the moment which is really anchored the sentiment of the stock market is the gradual reduction in tighter financial conditions, which now are expected to be in the second half of this year. And it's really interesting you did that poll before, because at the moment, the market or the Fed fund futures is 50-50 on whether we'll have a rate cut in July. So it's quite, I think, quite interesting to see that alignment of expectations on something that is so important and pivotal to not just the performance of the stock market, but debt markets, currency markets, and whatnot. So I guess as we emerge from COVID, you've got you obviously had all that slowdown in economic activity because of COVID-19, but you had subsequent recoveries. You've had heightened geopolitical tensions, and you've also had the surge in inflation. So that's the major economic themes that brought into this year. There's three key macro drivers that we'll kind of hone in on in the discussion. And the first is what we discussed about, the if and when we have the reductions in interest rates. Number two, the very gradual, increasingly gradual recovery in tech, trade, manufacturing. And then thirdly, the very familiar theme of geopolitical tensions. What a key thing for us has been is having a very diverse stock market. I think it's a absolutely incredible stock market. The only shame about Simsky is that it doesn't cover enough of our stocks. Obviously, Phillip are right in there with us with our stock market, because you've been our member broker and close advocate and good friend for many, many years. And the diversity, you know, I don't have to kind of really spiv it up. Close to 180 stocks alone have chalked up gains so far this year. Just over half of those have seen net institutional inflows, less than half have seen net retail inflows. One company that has been restructuring itself since joining the SGX watch list on financial reasons has actually been the strongest performer this year, Bangkwang Marine. Hiep Seng Industries has been the least performer of the 250 stocks that have declined so far this year. So basically, for every 4 stocks that have booked declines, you've had 3 that have booked gains. For every 20 stocks that have booked net institutional fund inflow, you've got 19 that have actually booked inflow. You know, there's one slide there that I might get you to flash up, the heat map of the various sectors, just to show you how the diversity works in the various sectors, if possible. It just shows that if you look at across the different sectors, you've got very different performances. For the first quarter of this year, banks were the most defensive. Good reason why, and we'll get into that more on the impact of higher interest rates on the net interest margin, which drives net interest income, which drives the total income, and obviously drives the dividends that we receive in our pocket. Telcos were the next best defensive. They've averaged 3% gains. They're about 3.5 to 4% gains. And of course, the S-REIT index has been the least performer, down 7%. And that's on the other side of that, what I would call an overarching economic theme, and that is the outlook for interest rates. Obviously, the higher interest rates impact net interest margins positively, but at the same time, they increase the financing costs for the REITs, which work into the distributable income of the REITs. So they're very textbook moves. We had very textbook moves with the onset of COVID, with sectors moving for good reason, very measured moves, and there's an element of textbook moves continuing. You know, as you'd expect, telecommunications would have been the most defensive in the first quarter of 2020 and the second quarter of 2022 for that regard. And all I'm doing is taking the average total returns of 3 stocks there on the telcos: Singtel, Netlink, NBN Trust, and StarHub. We've also got a lot of travel and hospitality stocks, but just focusing on 3 in the travel and hospitality arc, you've got Singapore Airlines, Genting Singapore, and Comfort Delgro. They also declined in the first quarter, but reason is our market has determinedly become very forward-looking in recent times. So you can see travel and hospitality, it also obviously underperformed in the first quarter of 2020, right through the third quarter of 2020, but it did outperform in the fourth quarter of 2022, right through to the second quarter of last year, and again in the fourth quarter of last year. So that's I think really interesting, because that's just 3 stocks again, just showing you that performance. And for investors too that kind of want to take a trading mentality into the market and rebalance and rotate their positions on a regular basis, consider that from the beginning of right from the second quarter of 2022 through to the first quarter of this year, the combined sectors, I don't think that's actually what I've got there isn't so right. That top line, it doesn't look that correct. But what I'm going to say is from the first quarter of 2022 to now, you can see you can add up all those individual price returns. So for this year and a bit of this year, you've got something like 30% returns, and then you add up the negative returns on the very least performing sector, and you've got something like 16% declines thereabouts. So you've got the ability to rotate sectors, and you don't have to do indices and a number of stocks and big baskets and so forth, but you can see there's enough diversity in our stock market for traders, and I think that's an element of tradability in our market that has continued to drive the day-to-day participation in the market. So, you know, every single day we have $1 billion Singapore dollars of shares trading hands. 25 cents in the dollar is in the banks, 20 cents in the dollar is in the REITs, another 20 cents in the dollar is in over 100 or so manufacturing stocks that have a lot of parallels to our actual industrial production here in Singapore, and relevance obviously to our trading numbers as well. So there's a lot there.
Okay, right. Thank you for the in-depth review. I think we're hearing that after COVID, the banking, the telcos, the travel sector has been driving the local markets up. So let's come back to present moment. Just last week, our Ministry of Trade and Industry released our GDP figures, showing a growth of 2.7% year on year in the first quarter of 2024. And it's also higher than last quarter. So are those factors that you mentioned previously, are they going to continue to drive the Singapore market? So maybe can you share with us your thoughts?
Yeah, actually, good question, because when you read below the headline GDP and you look at the 5 sub-aggregates, the 2 goods producing industries, that's construction and manufacturing, makes up 20% of the GDP, 25% of the GDP, thereabouts. And then you've got the remainder made up of services producing industries, which there's 3 of them in total. You can actually see on a quarter-on-quarter basis and on a year-on-year basis, the GDP growth is broadening here. It's being less uneven. So that's important when you've got that very diverse stock market spread over new growth industries, different sectors, different industries, and so forth. So what was it, 2.7% year-on-year growth, followed 1.1% growth last year for the full year. It followed, 3.8% growth in 2022. What was good was all 5 industry aggregates, they expanded year on year. Construction registered 4.3% growth. That services industry, which is comprised of 3 sub-industries, that's information and communications, finance and insurance, as well as professional services, that was up 4.2% year on year. And then if you compare it to the previous quarter, 3 of the 5 industries in the first quarter actually declined quarter on quarter, but that's after they printed really strong growth in the fourth quarter of last year. And then you saw 2 industries actually put strong growth on in the first quarter, quarter on quarter, and they were seeing turnarounds from the fourth quarter contraction. So there's an element of broadening and there's an element of moderation in the sub-industries. That's good news for our very wide bandwidth of sectors and industries in our stock market. So as I said, trends are indicating that Singapore GDP growth is becoming more broad-based, which is good news.
Okay, well, let's hope the momentum can continue throughout 2024. And as I was reading up in preparation for this session, right, actually I came across one of your article published in Business Time. It's a very interesting article. You shared that retail investors provided a net inflow into Singapore stocks of 1.1 billion in February. I think I have one of the slides to show the article.
Yeah. You must
So,
be the other reader, Simon.
So I'd just like to ask, what is the significance of this information that you are sharing in this? Okay, can everybody see the article here?
You know, I studied economics in high school, uni, 30 years ago, more than 30 years ago. And we in economics, there was this thing called revealed preference theory, which businesses would use to try and understand the consumer behavior of their market. We do it in the same thing in the stock market. We want to understand what retail investors are motivated by. In Singapore, I think it's a little different. When you look at the retail inflows and you put it, not that you need to all the time, and it's not that it's necessary, but if you do look at it in terms of what the market risk is like, what the volatility is like, what the performances are like, what they're holding from the first place, and just look in and you can see that revealed preferences actually show that retail investors are more active when the STI and its constituents underperform its global peers, or when various sectors underperform other sectors, as opposed to comparative outperformance. Because there's that old, there's that old, I don't know if it's a cliche adage, but that retail are always in too late, and just follow the comet, and then the retail always go in last and buy high and end up selling low. Oh, sorry, yeah, doing it that way because they end up getting in too late. But in Singapore, you can see that 15 billion Sing dollars, right? When you break it up in the different years, you can see that in 2020, when we had all that volatility of COVID, that's when we had the most net retail inflow. That's when we really underperformed global markets because in the STI and the 50 most actives, we don't have a lot of tech plays. It was the tech plays because of the live streaming that really came to the forefront. So case in point, back in that year in 2020, the biggest trade I've ever seen in our stock market, it actually took place. It was retail investors buying DBS with a volume weighted average price that year of around $21. Then retail net sold the stock with Singapore $1.1 billion when the volume weighted average price was $28. So you can see the trade that was happening there. We have a lot of ETFs now. I think we've listed something like 20 since 2020. But in 2020, we also saw something pretty incredible with our 2 STI tracking ETFs. It took 17 years for the 2 STI tracking ETFs to reach 1 billion Singapore dollars in assets under management. And the 17 months that kind of overlapped with 2020 saw the AUM double. Just 17 months. It only took 17 months for the AUM to double to 2 billion amidst the volatility. Now, it's okay, well and good to say, okay, retail a lot more active in times of volatility and when the markets are perceived to be low, undervalued. But you can also see in the year of 2022, we were pretty much the strongest performing stock market across the world, helped by our Singapore dollar, but we were up 8%, S&P was down something like 15, 20%. That's when we saw the least amount of net retail buying, when we were actually outperforming. If you look at this year, here and now, okay, you've got REITs, as we saw in that little heat map just before, remember, down 7%, the IHS REIT index. We've seen 530 million Singapore dollars of net retail buying in the REITs. Stocks that have averaged 5% gains this year have been among the 10 most net sold by retail investors. That includes Yangtze Jiang and Franklin Group, which are both up around 20% this year, are in those 10 stocks. Then if you look at the 10 stocks that have been the most net bought by retail investors in Singapore so far this year, it's those stocks have actually averaged 10% declines so far this year. And that includes Cetrium, which is down 30%, CDL, and MLT, that's Mapletree Logistics Trust, which are both down around in the vicinity of 15% as of the end of last week. So this is the thing. I think really important to understand for all of us, the language of investors and traders here in Singapore. You know, retail investors net buy 1 billion of Singapore stocks in early 2024. I probably could have got a much stronger reaction from the trading and investors here if we said sell, 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 or something a little bit hysterical that implied we're a bit undervalued.
Okay, so it sounds like a reverse indicator kind of thing for us.
Well,
Yep.
well, we know. I mean, a lot of the investors that come along to the Phillip events that I've always done with SGX, with Phillip Securities, Phillip Capital, Phillip Nova, and so forth, you're pretty smart. Very, you know, you can't, you know, they're not going to sort of follow comets and stocks that are crazy valuations and so forth. So, yeah, I think it just reflects a well-seasoned, relatively sophisticated retail investor base here in Singapore.
Okay, great for sharing. And we have been zooming into the Singapore markets so far. So now let's zoom out, okay, and take a look at how global events will likely impact Singapore market this year. So once again, before that, right now we would like to hear from the audience again. So now we are going for a poll. So the second question that we are going to ask the audience is, do you think interest rates will drop, rise, or maintain by the end of 2024? So Sri, can you help us to show the poll question.
Yes, poll has been launched. Members of the audience, please vote now.
All right. Can we have the result of the poll?
Isn't that interesting? That's so.
So that's
sorry.
57% stating that it will drop, 14% feel that it will rise, and 29% feel that it will remain the same. Simon, over to you.
Yeah. Okay. All right.
Simon, that's the exact same, very similar, remain the same, very similar to what the professional forecasters are saying too.
Yeah, I think that's no surprise. Actually, it's probably a mixed signal from what I see, because we know that the interest rate is still what do you call it? The policy that is still, the government is still trying to try out, is testing water. So I think maybe they are also not sure what's going to happen. So I'm not surprised that this flows to the sentiment into the markets. But other than interest rates, of course, we would like to hear from you, Geoff, on your views on interest rates. But other than interest rates, any other factors that you think investors should take note of this year?
Yeah, I think the tension, geopolitical tension, it's going to be a long year, obviously. And for some time, we've been talking about the gold ETF and the importance of the gold ETF. And, just last week on Friday, it actually traded above 300 Singapore dollars a unit, our ETF, for the first time in history. And that was on the escalating geopolitical tensions in the Middle East, which have escalated one step further, and now the world's waiting to see what Israel does in retaliation to the drone attack, which obviously was well fought off. But that's, this index, I think, the Spider Gold shares is super important. It's traded, as we say, in US dollars and Singapore dollars here in Singapore. 1 unit in the ETF is equivalent to 0.094 ounces of gold. So you need to buy about 11 units to have exposure of 1 ounce. And, over the past 2 weeks as well, the average daily turnover of the ETF has reached its highest levels in 4 years. We have to go back to excess volatility in 2020. So this is really important. But what's also equally important for Asia is the outlook for manufacturing trade, as well as the outlook for the China economy. What we're seeing is some of the paradigms shift a lot over the last 4 months. So remember, we get flooded with 2024 outlooks at the end of 2023, just like the year before. They're mostly outdated and redundant within 2-3 weeks. And what we've found is that what the market has moved on from with the interest rate outlook is smooth landings. So markets are really, stock markets are becoming more of a barometer, not on the if and when we have rate cuts, but if and when the Fed Reserve can facilitate a smooth landing. The thing is, the longer the growth and the better the growth, the longer they can keep the rates up. But we've done some modeling on the PCE core deflator, which is the Fed's preferred gauge of inflation. You look at the data, simple basic extrapolations going back with all the data that goes back good 20 years, you can see there is a risk that does start to level out at 3%. And if that's the case, then you could have obviously less chance of that that smooth landing. So that's the if and when of the tightening of the financial conditions is number one. Number two is the manufacturing and trade. It has been more muted than we had hoped. January started with super strong trade numbers in Singapore, Taiwan, and South Korea, and then in February it was much more muted, and then in March it's been mixed. So these are the three core countries that we really gauge the regional trade and regional growth outlook on, and the problem is it's going to be gradual. So what I love about this Singapore stock market is that you've got this 2024 inflection points mostly happening in 2020, in the second half of 2024, if they happen. So we weren't going into the year with a bang. We were going in with a, having to be patient. And in the meantime, companies have had to continue optimizing, employing proactive capital management measures to add value to the shareholders, just as we do as an investor. As an investor that oversees a portfolio of different assets, we need to find ways when markets aren't moving to make the portfolio more efficient in generating returns. And we've seen that with a lot of our companies as well. So you've got the macro, which is obviously the regional growth, the interest rates, and the geopolitics, but you've also got a lot happening on the micro front, and companies really embracing the long-term structural trends here, such as digitalisation, sustainability, and of course the newer regional integration across Southeast Asia that's trying to basically conjure up a lot more growth going into 2030.
Okay, yeah, I think geopolitical tension probably is one of the biggest risks we have seen so far. We have been seeing the headlines, and every day there's new things that's happening. And of course, other than geopolitical tension, right, we also see that there's a different kind of war going on. For example, the chip war between the US and China. Okay, so the next question I would like to pose to Danish, okay, because I think I understand that he has been doing some research on this chip industry for a while. So Danish, with the chip war ongoing between US and China, okay, how do you think this will impact the Singapore markets?
Yes, hi, let me bring up my slides. So one thing about the chip war, right, as you can see in this image, it hasn't really been focused purely just between US and China. It's actually across the entire world, throughout the entire world. A lot of countries, they are having a lot of, they're giving a lot of incentives to various semiconductor companies. And the main goal really for these countries is that they want to incentivize all these massive semiconductor companies to manufacture their chips in their country. And this will help create jobs, boost the economy, and perhaps more importantly, from a geopolitical standpoint, it gives them some control over the semiconductor supply chain. And I think a key takeaway is that in this tug of war, we are likely to see a reconfiguration of this global semiconductor supply chain, and Singapore really could benefit as an alternative destination. In fact, I think just last September, we had Global Foundries. They opened $4 billion fabrication plant in Singapore, and we also had Applied Materials who opened their own factory in late 2022. And I think the strength of Singapore and what attracts these companies to our country is mainly due to Singapore's safe haven status, as well as our geopolitical stability. And really, as more global companies shift their manufacturing to Singapore, a couple of local semiconductor shares could benefit. And one thing to understand, especially for Singapore, is that our local semiconductor market, they majorly consists of what we call the outsourced semiconductor assembly and test companies, as well as the ATE companies. And essentially what they do is that the OSAT companies, they provide testing services, and essentially chips after they are made, they have to be tested for their quality and efficiency. And this is important, especially for AI, because the more complex the chip is, the more stringent the testing requirements are. And then for ATE companies, of course, they essentially create the equipment that are used to test some of these chips. And some companies, right here, we have a UMS Holdings, Grand Venture Technology, as well as AEM Holdings. And all these companies, they should benefit as long as we see more semiconductor companies move their manufacturing to Singapore, because as long as the chip production is increasing, there will be greater demand for their services as well as their equipment. So, yep, I hope that answered some of your questions regarding this point.
Yes, thank you, Danish, for sharing. And I think let's dive deeper into this chip industry. So we know that in the US, AI shares has been dominating the talks and the markets. So Geoff, I understand recently you did an interview. We just like to ask you also to share here, digitalization, tech, AI, has already driven the US stock market. Do you think the AI rally has hit Singapore?
Yeah, the fever has not. I would say the fever hasn't, but we're in the very early stages of this. So I would say the bigger, broader digitalization, and I guess what do we call it? Comparatively more wholesale digital transformation. AI is a key driver of both of those, and this is one thing that has been, forgive the pun, embedded increasingly into what a lot of us do in not just Singapore but Southeast Asia, which, as we all know, because Google come out and remind us in this Google document every year that ASEAN's going to become a $1 trillion $1 trillion internet economy by 2030. So that's basically doing wonders for digital consumers and merchants and accelerating e-commerce. We punch so well above our weight too, as Danish was discussing. If digitalization, or let's say digitally delivered services like financial services, like what we're doing right now, if that became, in terms of the value of it, the dollar value of it, and that became your criteria to join the G7 across the world, we'd be sitting very close. We actually rank as the 8th largest across the world. We'd almost be in the G7. So, cross-border work through computer networks, the increased digital intermediary platforms, financial services, all the IP-related insurance and telco services, and etc. That all goes into that. And this is the cool thing with the SIMSCI. So if you look at the company reports that our four of our biggest index stocks, so DBS, UOB, OCBC, and Singtel make up 56% of the SIMSCI weights. Digitalization has been playing a key role in the service delivery of these businesses. The majority of the three banks, their customers are all digitally enabled. Singtel growth engines include the NCS, the data center, and its digital banking services, but digital businesses are growing in scale. And at the same time, you've got, I think, C and Grab also make up 12% of the SIMSCI as well. So digitalization is a big long-term structural theme, and it's also a really big part of the SIMSCI. And we'll see more of this and read a lot more of this, as Danish mentioned. This 2024 rebound in the global semiconductor cycle, yes, it's taking some time, more than we thought, but this is supposed to continue all the way through to 2026, according to the Association Semi. And your wafer shipments are going to be setting new highs on the not just the AI, but high performance computing, 5G, as well as the industrial automation and so forth. will be, all those industrial applications and so forth. So we've also, iEdge also put together, this is really interesting too, because it's a page, and I'll share with you, Simon, that you can share with all the customers. So the iEdge scientific beta guys also put a AI index together based on I think 30 US companies, and they found 30 revenue streams that are relevant to AI adoption. And it basically spans 3 industries: hardware solutions, software algorithmic AI solutions, and industrial applications of AI. And one of those stocks just before that Danish had on his screen actually comes under the banner of one of those revenue streams. The stocks all have varied, when you look at those, you use those revenue streams as, potential kind of AI exposure. And you've got a number of stocks here in Singapore that have varied exposure. StarHub reports 15% revenue to network security software. That's seen as a revenue stream directly relevant to AI. Silver Lake Access, it maintains AI and machine learning and large language models is widely used in the banking sector to automate routine tasks. And it's addressing that through its CloudLink solution. And I also just want to check on just tech in general as well. Just because you're not necessarily an AI stock or known as an AI stock doesn't preclude some pretty big moves. One stock in particular that I wanted to share on is Franken Group. So it has led the handful of our tech-focused stocks last year and so far this year. And this provides those OEM, ODM type of solutions in analytical life sciences, automotive, healthcare, industrial, semiconductor industries. It's in Asia, it's in Europe, it's in the US. Outlooks have really driven its performance, particularly last year. So, and this is the thing, this is another great thing about our stock market. We have a number of research analysts, a number at Phillip as well. This one's at another bank, another broker, and he has form on the stock. And you can see when he makes a call on the stock, the market listens. Back on the 15th of August, this particular research analyst raised his TP on Franken by 28% to $1. And he upgraded the stock to a buy. Okay. Now this, prior to this, Franken had reported its first half results. It was trading at 82 cents. The whole day after it reported its results, not much reaction. In fact, it actually closed down 0.5% after it reported. And then the day after is when that research analyst upgraded the target price to $1. Now, why he did this, he said he saw the earnings cycle for the company approaching a trough, and he noted that improved earnings quality would be in the medical and the analytical and life sciences segments. They could be contributing more. And he added, Franken has these diverse revenue sources, and that's going to help the company remain resilient in the tough times. And when he did that upgrade, an upward revision, the next session it went from 82 cents to 94 cents. And then since then, he upgraded the target price to $1.23. And then in the third quarter business update, Franken noted its revenue for the second half would be stable as compared to the first half, and that its medical revenue actually did increase 20% year on year in the third quarter. And its analytical and life sciences also increased 20% year on year in the quarter. So the research analyst called it. And therefore, he has since been able to raise the price, and he's since raised the target price to $1.65, which I think is where the target price is now. And that's after it reported its full year 23 results. He's since revised it up to $1.74. So the share price, I looked on Monday, I didn't look at it today, it was at $1.58. So it was up 19% for the first 15 weeks of the year, up 48% in total return last year. I think, and up 95%, I think, since the end of 2019. So my point of the story is that investors, please use the research analysts at Phillip. if you're looking to delve into the stock market, they do a lot of work covering these stocks. And when they come out and make some calls, sometimes they absolutely nail it, like this gentleman did.
All right. So I hope we catch what we have been hearing so far. Although, like I mentioned in the start of the session, there's no trading call, no buying call.
Yeah,
no,
that's right. I mean, this has all happened in the
financial,
past in history.
yeah.
Yeah.
I understand that. Yeah. So, right. So, thanks for sharing, Geoff. So we have spoke about macro, micro, and also diving into different segment of Singapore market. So, in view of time, I'd just like to ask Danish one question, okay? Because Danish is the younger investor, okay? Geoff and me, we are the young investor, so Danish is the younger investor. All right. So as a younger investor, Danish, what value do you think the Singapore market can offer you?
All right, so let's answer the question. Let me show some of the slides that I prepared. So I think for the Singapore market, especially for younger investors, not many people are actually aware that when you compare it actually to some of the global developed markets, especially the S&P 500, and when you look at it from a forward PE ratio perspective, you see that Singapore equities are actually looking pretty cheap. So how do you interpret this graph over here? You can see that for the SIMSKI index, at least over the past 10 years, the average forward PE ratio is around 13.2, while for the S&P 500, the average or the 10-year average is around 18 forward PE ratio. And currently, the SIMSKI is trading about 1 standard deviation away from the average, and the S&P 500 rather is trading about 1 standard deviation above the average. So really what we can, the main takeaway from here is that Singapore equities, they're relatively cheap from a historical perspective, as well as when you compare it to the S&P 500. So another thing that I want to talk about, for Singapore is that we are probably quite, famous, or we are quite known as a very high dividend yield or dividend paying stock market. A lot of our stocks, for example, the top 3 local banks, they pay very high dividends. And you can see over here in this, chart I provided as well, SIMSKI has a dividend yield of about 4.5, the STI about 5, and you compare it to the Nasdaq as well as the S&P 500, which is the orange and green line. They only provide a dividend yield of about 1.4 and 0.8. So, if investors really want to capture dividends, they can choose to invest in some of these, our local banking stocks. Of course, I think SGX, we also have SIMSKI futures based on total returns. And total returns basically includes dividends as well as capital gains. So based on the high dividend yield as well as the valuation discount, we can say that Singapore is historically a value-oriented market. Although for the SIMSKI, the inclusion of Grab and C does make it have a slightly higher growth exposure. So lastly, I think for younger investors, the Singapore market can very importantly provide diversification benefits. And this is very important, especially if you have a very, US heavy portfolio. This graph over here shows us that the SIMSKI index, when you compare it to the S&P 500, it has a correlation of about 0.48 or 48%. And this is really the key, when it comes to increasing your portfolio's diversification. And the main goal for an investor would be to add as many uncorrelated or assets with low correlation as possible. And this is really the holy grail of investing. And the Singapore market, the SIMSKI index is really a pretty good product, for investors. And that's my take, at least for as a younger investor on the Singapore stock market.
All right. Thank you, Danish, for sharing your views. I think we have been hearing a lot about SIMSKI. So in our last segment, before we come to the end of the session, I would like to go into more product specific. So we know that in Singapore, there are two main indexes that's tracking the Singapore market. So one, the STI, Straits Time Index. I think we are familiar with that. And another one is the MSCI Singapore Index, SIMSCI for short. So Geoff, I like to ask you, so after the inclusion of Grab and C Limited, okay, C Limited, I think is the holding company for Shopee and G Arena. Maybe we are more familiar with that. After inclusion of this Grab and C Limited into its composite, how does this impact the performance compared to the STI?
Okay, I've got a slide. I don't know if you've got it, Bloomberg chart, if you can share it and flash it up. But it basically, it's been varied. Just while you pull it up, I used to broke the SIMSCI futures when I was a young guy in the 90s, in the late 90s, when these first came out, in the late 90s, of Jardine Fleming in Sydney. I was broking this, one of the first Aussie to actually place orders through the Cargill futures, you know, on the floor in Cymex. And this bottom green line, this bottom sort of part segment is showing you the correlation of basically correlation of SIMSCI to the Straits Times Index, and you can see it's gone. It used to be very high. It's then gone lower because C was so huge at its hiatus, and then the correlations gradually come back to around 90% above. So this year, SIMSCI has outpaced STI. Last year it didn't. Okay, we could do a poll, just check with everybody if they can guess why STI. Actually, the three banks have a very similar. Three banks have a little bit more impact on the SIMSCI than they do with STI. SIMSCI weight is exactly 50% for the trio of banks, but it's about 49% for the STI. So a little bit outperformance, underperformance. What I'd love to see investors take advantage of is spread trade the two, the SIMSCI to the STI, because you can see there's enough variation sort of on a short-term basis. When you look at the second, the middle green line there, it's showing you the price ratio spread of the SIMSCI to the STI. So SIMSCI has underperformed STI, and as you can see, it's gradually starting to pick up. Underperformed during that 2022, obviously, with the inclusion of the Grab and the C. As we said, it's you know, I don't think it's a. I think what C is 9% and 3% for Grab. It's super thematic when you look at it. This is not just a Singapore index. This is a great Southeast Asia index that's very important to some of these long-term structural themes like digitalisation. There's another slide that Maurice, the product manager of the SIMSCI, has prepared as well, if you've got it there, just to show you and reassure you that investors are embracing and continuing to embrace the SIMSCI. The trading turnover in terms of volume, I think in March last month was 63,000 contracts, which is what, $1.4 billion a day on average. So that's the second consecutive month that it's above 60,000 contracts a day. And just for a base, it used to be averaging around 55,000 contracts a day. So what's great is the SIMSCI has not come off to prompt the extra volume in the contracts, but it's actually, as we said, been very, very level. So yeah, this is one index very close to our hearts. And if investors want more information, Simon, you know where you know, come through and ask us. I still think it's you know, it's made up of a lot of really good, interesting companies. So there's a lot of liquidity, and there's still a lot more we can do in terms of opportunities to, you know, for investors to look to optimize their portfolio with the stocks they hold and hedge more with the SIMSCI futures. You know, a lot of these companies, a lot of the investors know very well as seasoned share investors. As we said, the three banks, which, you know, as Danish mentioned, have incredible dividends. You know, the dividend yields for the three banks at the end of last year. So you take out the FY23, all the dividend distributions that DBS, OCBC, and UOB paid for that last financial year. You look at the end of 2023 share price, it was an exact 6% yield, which is really super strong. So as you know, as a yielding market, it's just you know, I'll zip it, but I could go on for another hour.
No problem. All right, and thank you, Jess, for sharing. But one thing I do know after SimSki include Grab and C, that the T+1 session trading is very active. So we get more trading opportunity, but lesser sleep.
Yeah, you know, and this is the thing with what we do at SGX. We've got to be catering to international investors. You know, many ways we're like Singapore Airlines. Singapore Airlines, if they were just catering to Singapore investors alone, there wouldn't be Singapore Airlines that the world knows. So we've got to find ways to make our products globally relevant, and also continuing to work with global investors, just like Phillip does.
And I think it's great because, you know, Singapore markets, we trading until about 5 o'clock, the equities. But then if, let's say, there's any news from the US and anything happens and you need to hedge, you can simply use the SimSki futures in T+1 session. It's still active, still liquid. You can still hedge our holdings during the night time. So I think it's a great instrument. And thank you for sharing. And if any one of you would like to know how to invest in SimSki or trade the SimSki, do leave a comment and we will get in touch with you after the session. And right now, we also have this promotion. Maybe I'd just like to bring out this slide over here. Yep. Okay. Yep. Okay. So right now, if you are trading SimSki, and we have this very good promotion. The commission is only 1.98, right? And it's starting since April, 1st of April, and it will last until 31st December. So if you're already our customer, you can simply scan this QR code here, okay, to get access to this SimSki promo. Right, so you just need to opt in to this QR code. So I'll just leave it here for 1 minute. And meanwhile, we would like to see if there's any questions that we can take for Danish and Geoff.
Members of the audience, now's a great time for you to type in your questions in the question box. Fire away and let Danish and Geoff and Simon himself address all the questions that you may have about the Singapore markets. Take this opportunity to type them and we will address them very shortly. Meanwhile, Danish and Geoff, what do you think? I mean, starting with Geoff first, what do you think should be the key takeaways for the audience based on what you shared today from today's session?
I think markets are super vibrant, very fluid outlooks at the moment. I think staying in touch doesn't have to be too complex. And as I've tried to kind of share, usual brokers and the services that they do offer, because they can be very helpful.
So just to chip in,
Yeah, Danish, over to you.
I think Geoff mentioned about the yield. You know, the Singapore market, the yield that we pay out is very high. And you know, just a slight comparison, most people, where you know, when they invest in, let's say, like an fixed deposit, the yield provided by fixed deposit is around 3%. And you know, Singapore markets, they provide almost double the yield. So that's a very good, you know, point to think of. And I think, you know, if I were to give any advice for the audience, I think you know, Singapore equities in general, they provide a form of stability. You know, Singapore is the only AAA rated sovereign in Asia. So we are a very safe country. We are viewed as a safe haven internationally. And again, I think diversity is key. And, you know, that would be my biggest advice as well. It's not really hard to achieve as well.
All right, thank you, Danish and Geoff. Okay, I think if there's any questions, just feel free to post it inside. Otherwise, you can email to us as well. So I think we are coming to the end of this session. I really thank both of you for your time. And Geoff, do you have any last advice for our audience? Final advice.
Yeah, I'm just I don't know if anything that we've said has resonated with you or you're interested in more. Please, do follow us on our Telegram channel or SGX Academy. I've been more focused on the stock market over the last 10, 12 years at SGX than I have derivatives, although, my history is derivatives. And I know a lot of the derivative brokers and so forth at Phillip very well. And they are a great team and wanting to engage with the investors as well. I don't hesitate to ask them any questions or ask them to clarify anything, or, in many cases too, when as brokers and intermediaries, we get asked, what's going to happen, and sometimes we don't know, or a lot of time we don't know, but what we do know is where you can find and what things you should follow to help you make those decisions as well. So we can help navigate and circumnavigate some of the more complex things of investing in derivatives, as well as what drives them. So what I'm just trying to say is don't hesitate to reach out.
All right, thank you, Geoff. Okay, I think that's all the time we have for tonight. And thanks, audience, for joining. And thanks, Geoff, for your generous sharing. We look forward to more insights from you.
Thank you.
All right, and thank you, Danish, for bringing us a view from another perspective, from the younger investor perspective. And that's all, I think. And good night to everybody, and hope to see you all again. Thank you very much for joining us. Thank you.